this brings us to the third topic, and you mentioned the keyword different or differentiation. So how can banks differentiate themselves? You mentioned the video conversations, for instance, and I had seen 2 years ago, actually, in Turkey, a bank had, for instance, created this sort of ATM/branch where there was nobody in the branch, but I, as a customer, could go in, the doors would lock, and I would be connected to a sales service assistant who would speak to me over video. So how, as a bank, how do you make sure you differentiate yourself?
Yeah, I think that, the question was certainly an interesting question, and I think if you look at how banks are differentiating themselves, in some respects it comes back to sort of the good old days. The way you differentiate yourself is through great products. So Santander wants to deliver more loyalty to customers, so we develop a 1, 2, 3 product that pays cash back on their banking, so that it drives a consumer behaviour. That's a fantastic product that drives, in some respects, the differentiation for the bank. Service is the differentiator, and that's enabled by some of the things that we're talking about. So, for me, fundamentally, it's not about, okay, we're going to open up a new video channel, because if the customer experience on the video channel is poor, it's not going to differentiate you, maybe differentiate you badly. What you have to do is to differentiate that actually enhances your service proposition to the consumer. And if you're able to do that, that's what will differentiate you as a bank and as a business.
Did you want to add something?
Yeah, I was going to say, on differentiation is such easy to say, and everybody says, oh, we can only do it through service, etc., etc. I think the real challenge is to keep up the differentiation through innovation on a consistent way, because every innovation gets copied very, very quickly. And therefore, unless a bank can continue to innovate, it will always be caught up by somebody else. And if you look at the history, there are many banks that have been innovative for a time. Very few have kept that innovation and differentiation as part of their culture. You can mention maybe BBVA, Bank Inter in Spain have managed to do it on a consistent basis, but other banks, in the UK, Nationwide used to have that reputation, but probably has lost it over the years, and they recognise that. Barclays has had it and lost it, and is probably getting it back again as an outside observer, because you come up with some new things. The question is, how do you keep that consistently, particularly if there are periods of recession when everybody says, let's stick to the knitting?
Let's let the banks.
I would agree with both views. So one obviously is the right experience delivery to customers. And more and more, I think it's relevant for banks to go to, or make people's live events great experiences, right? As opposed to, so for example, buying a house is a life event. You don't do that every day, and the bank shuts at a certain time, right? So if you need to find out about a mortgage to do that, you ain't going to look for a bank to do it at that time. And it would be really nice and convenient if the person, while going through the experience of looking at the right house for the family, is able to initiate, understand what it will take in terms of mortgage payments, whatever else, before he or she can carry on with that life event. So the right customer experience is very, very key, and innovation is obviously a big deal, and especially for Barclays, right? So classic example is Ping It. In all honesty, it's a payment mechanism, but what you do with it and how you enable the various permutations and combinations is where all the innovation comes in, right? Once you have established the core pipe, then how do you maximize the different opportunities that it has to deliver? And if you look at other things which are, I wouldn't call them truly innovative, but they're around making the basics great, for example. So we, for security, we've got a device called Pin Sentry. And based on customers' input, it's obvious that that's an additional device they have to carry when they certify certain payments or when they have to log in online securely to get full access, things like that. People love the security, but do not find it convenient to carry yet another device. It's a small little calculator-like device. So at the back of the feedback, we added to the Barclays mobile banking app a mobile PIN entry, and customers love it. Right? So there are lots of things that we've got, and the other thing is, which is very critical, is the rapid delivery of that experience to the marketplace. So you can test and learn, and then retest and learn, redeploy, things like that. So we've got a 6 to 8 week delivery life cycle, right from idea inception to delivery to the customer, which is something that's been going on for the last couple of years.
I think one of the areas in terms of differentiation that I think is incredibly important is moving with customers and moving to what I like to call point of decision instead of point of sale. And up until about 10 years ago, 90% of financial services decisions were made around 6 to 7 p.m. at home over dinner. Right? And then you executed that decision at 9 o'clock or whatever the next morning. That was generally speaking the way banks did. But I think what we're seeing now in the world is that people want to make those decisions when they're at that point. So if they want to buy a house, they want to make a mortgage decision probably while they're standing at that in front of that house or talking to the real estate agent. They want to buy a car when they're at the dealer, they want to make that decision right there. One of the things that omnichannel gives us is the ability to allow people, if they choose to make the decision and do the transaction at the point where they want to make that decision, not having to wait. And I think that's one of the key differentiators that omnichannel gives us, whereas before we always had to get them back, and we always had that opportunity of losing them between the decision and the execution.
I think that's an interesting execution element. I think we learn from retail here, I really do. Research is very, very clear. Consumers become loyal and feel that they're getting a differentiated service when it's personalized, simple, and easy to execute. And there's tons of retail research out there, but that ability to continuously deliver a personalized service, personalized gets real expensive. So I think the differentiation among banks is going to be the bank that can deliver that personalized service across segments in a profitable way so they can sustain their business. It sounds like a simple answer, but I really think that's what it comes down to, and the research shows that. So what is personalized value to your customer? And it could be my mortgage gets executed when I need it. It could be that when I have a break in my day, I can gain specialized advice and not have to go across town. It could be that my transactions are handled very smoothly. And I think we need to gain that understanding and then figure out a way to execute it profitably, because in the end, banks are here to make profit.
Yeah, a question to add on to that would be, how do you find this balance, between, learning from others, or, taking something that someone else has developed to the next level, but also, how do you balance that out against sort of selling your know-how? I'm thinking, for instance, of Guarantee in Turkey. You've got the bonus scheme that other banks are using as well, but you came up with it.
Actually, Guarantee has different digital services in the market today, and one of them, for example, you can send money, touching your iPhone to another iPhone. You can make a money transfer. It's a way. There's a company in San Francisco, who gives this service. There are 10 people in that firm, in company, and they are in San Francisco. But today we can make this transaction with the help of their services. So this means, banks are here, the financial institutions are here, but there are some non-traditionals. And non-traditionals, as you mentioned, 15 minutes ago, they are really important. And if banks and the financial institutions will collaborate with them, then the success will come. Because we shouldn't look at only our verticals. There are many verticals. Retail is some of example, but there are different examples in different verticals. If we can look at them and we can find the good services and copy them, or create different values from them, then there will be a different learning for the financial institutions. There will be also vice versa.
It's interesting you didn't do it yourself. And there's that huge conversation around cloud and accessing cloud-based delivery as a differentiation, and I think we should bring that up because it gives you agility and speed. And we do see customers of ours around the world leveraging different capabilities, and they get it. What would it have taken for you to develop it yourself versus finding a partner in San Francisco that you can use right away, and boom, you're delivering it in a very short period.
What I find interesting in financial services is that many of the real innovations have been started by new players. So all the peer-to-peer businesses are basically new. But none of them, because they don't have the brand, they don't get the scale. And you would normally expect in other sectors, or somebody will come in and buy them. Same thing's happening now in advanced advice. There are lots of new players in offering wealth advice. Small, probably none of them will meet scale. So I'm looking for the big brand names, if you like, to start buying these new innovations, which is certainly a Cisco philosophy. We buy lots of new innovative companies when we see them, but I haven't yet seen it. But perhaps some of you have some examples? Because that is a way to get innovation, isn't it?
Certainly, that's one way of growing the business. I think if you look in banking, most market banks' market share globally has been pretty small, and banks and Santander's growth has been driven off of an acquisition strategy. That's how we've grown as a business. I think, obviously that will reach a certain point where it becomes difficult to grow in that way, and therefore as a business you'll definitely have to become more innovative in the approach that you take to actually be able to continue that growth as a business, because you can't sustain it through the sort of the acquisition model that's happened in the past.
And I like that connection, because we say the demographic is now a behavior, and maybe what you acquire in the future, instead of the classic acquire branches, you acquire a capability that allows you to address a behavior. So you can see how that path would change to increase your products per customer, which of course is one form of growth, as well as your organic growth, in just acquiring customers.
I think we have to just be very blunt here. We're at war. We are at war with retailers, we are at war with mobile phone companies, we are at war with automotive organizations, all trying to take our business. And there's one thing that we have that they will never have, and that is advisory services. Mm-hmm. If we want to differentiate this industry, if we want this industry to survive, we need to focus our technologies on delivery of advisory services, because I can't see any government giving a grocery store the ability to give advice. Well, at least I hope not. But as long as we have advisory services, we can win. And my biggest issue with the financial services industry and retail is that we're giving up advisory services. Yeah. In my opinion, we're putting a gun to our heads and we're pulling the trigger.
Just a comment, because we hear so much of this right now. The biggest fear we hear is that we're going to be disintermediated to be transaction processors. Several years ago, you remember we were talking high tech, high touch, and we need to create a balance. There's a concern that for cost reasons, we drove the high touch out of our business models, and that we're really moved more towards a transaction, especially in our branches. Many of the branches couldn't afford to have a small business lending expert or mortgage expertise and so forth. And so they're just transaction models. And of course, that's the thing. The customer wants to be efficient, wants to go through your digital channel and just touch something, have it happen overnight. Meanwhile, I can't emphasize enough what he's saying. The consumers, especially the research we have, are saying, look, I'm looking for you to advise me on sources of uses of funds. It's almost all the way back to the first fundamental. Help me leverage the money I get. Help me understand how I can put it to use in the best possible fashion. And if you can do that in my terms, wherever I am, when I want to do it, I'm yours for life. And we're actually hearing that there's actually loyalty tied around that delivery of advisory service.
I have to say that I agree with the point that you've made. Banking and traditional financial services is about relationship. It's about the relationship with the consumer and being able to deliver that. So I think, maybe 2 to 3 years ago, I think you definitely saw that. You saw that banking was actually quite an attractive industry to be attacking and going into. However, cost of regulation and everything else means now suddenly, if you're a telecoms provider, I'm not so sure it's quite as attractive as it used to be, because the regulation that needs to go into selling a mortgage is very, very substantial. And in fact, where banks are going to have to innovate in the future is around how do you streamline a mortgage process, because the regulation now has become so complex that the interview that you have to have with a customer is so long, because you have to find so many different facts from that consumer, that you're not going to be able to do it in a single interview. You're going to have to split it up, and you're going to have to use digital to capture information from the customer. You're going to have to use the data that you already have on the customer to actually reuse that rather than keep capturing it back. So I think there's a lot of innovation, but I'm not entirely sure that we're seeing that. I mean, the co-op aside, who obviously are buying a part of Lloyd's to bring themselves into the sort of the bigger banks, if you like. I'm not seeing the Tesco's.
I agree with Matthew on that. Retailers come and go in this world. They have done from 20 years ago, but none of them seem to stay the course when there's a difficult environment. They then tend to downgrade a bit their activities, which you're already seeing here. That doesn't mean, though, that they are providing some fantastic experiences to their customers, and that's where, to my mind, the main threat from the retailers is that they're raising this expectation of service levels, which the banks have got to react to. The real innovation and the competition, I think, is much more likely to come from the small, new, innovative players who are struggling to get scale, but one or two of them may eventually succeed.
The one thing I think in banking is that the thing that will make a true differentiator is a bank or an institution that could become the trusted bank. But coming back to your point, it's very expensive. Cost of regulation and everything else to become a bank is actually very difficult. Cost of marketing that, is very, very substantial. So you're going to have to be able to find funding in the market to bring something, new to market, which I still think will be very difficult. I'm not seeing the type of funding that will be required for that type of startup proposition being available on the table. Maybe in a few years' time, I think, but let's see, never say never.
I want to wrap up this topic, and you mentioned costs. So, you've got, on the one hand, as established banks, you've got this opportunity to create something much better than, what some emerging players might try to take away from you. On the other hand, obviously, you still have to run an efficient business. How do you find that balance, and how do you find some cost-efficient ways? We've talked about mortgages a bit, so maybe we can use some examples in certain business areas.
Santander. We've got the magazine in front of us here, the Batin's model here in the banker. Santander's model has been built on efficiency. We've gone out, we've acquired businesses. We're a very efficient business, and I think that enables us to bring, to give back more to the customer and to the consumer, to offer more innovative products. If we weren't as efficient as we are, we wouldn't be able to do that. So, at a fundamental thing is that to be competitive in the market, you have to have, a low cost of base to do business, and every additional pound that your business costs to run is a reduction in your profitability, a reduction in shareholders, a reduction in what you can give back to consumers in services and propositions.
I think that we've seen a sort of a pivot point within the banking industry from, and let's be clear about